specifically focus on multifamily investing, but we try to teach about single family investing and other vehicles just so you can start planning for retirement or sitting on the beach like Bobby does or whatever interests you. So
Yeah, yeah. Thank you, thank you. So real quick, myself, I'm a private money lender. I am a syndicator. So if you got, we're here to provide you with education, networking. If you want to bounce ideas, if you're just looking to maybe just exchange some thoughts, Yana and I, we're here. But our platform is here for you to network. We believe that the better educated you are, the better informed decisions you're going to make about real estate investing. But yeah, and then maybe if we have time today, I have a real estate startup. Maybe I'd like to give you guys a demo if we have time. So anyway, with that, Bryan and Nathan from the East Coast, take it away. Thanks for joining. Yana, do you want to introduce Bryan? I know you and Bryan have known each other for a lot longer than I have.
Yeah, so I'm actually really excited to have Bryan share with you guys today some of his multifamily matrix, which is his learning platform. Bryan's actually a best-selling author. He has tons of property management experience. He has provided some content on our page, and we appreciate everything he does, walking us through properties, showing us how he troubleshoots multifamily investments. He has a ton of knowledge, and I've actually been a student of his multifamily matrix. So I actually read his book, Buy It, Rent It, Profit. I also have his other book, The Landlord Entrepreneur. And he's a reason that I wanted to bring him to this platform today is because we're focused on multifamily acquisitions and investing, but I think it's so important to know the operational side, which Bryan has a ton of experience in. So Bryan, with that, I'll let you take it away. Thanks for being here with us.
Thanks for having me. I appreciate what you guys are doing, and appreciate having the opportunity to participate and speak to your group, even though it's not in person like we once thought maybe a year ago that we'd be doing this live at
one day
in Cali. Yeah, one day, just not 2 days. So doing the second best thing, but it's also, a time right now where, there's a lot of uncertainty in the market. So there's a lot of questions and there's a lot of talking heads. So it's kind of hard to know who to trust. So you kind of want to lean on those who have been around for a few decades doing this. So what I've decided to do is quasi switch this up and give you guys a real life example. I think people best learn when they actually see a practitioner at work. I know I do. I try to learn the golf swing for the first time. I went to I studied and went to the golf course and watched a lot of the touring professionals practice. For me, that's how I do it. And you watch YouTube, but there's only so much you can do watching YouTube. You got to really get out there and see a practitioner at work, look at their habits, pick up their habits, see what they do, how they do, and so that's kind of how, I like to really approach everything we do here. And that's what I'm going to do for you guys today. We are currently, of course, for the last 9 months, we've been raising money. I anticipated, about a year ago, Nathan, some sort of recession. Of course, I didn't predict a COVID-19. I don't think anyone had, but I did, started thinking about a recession and opportunities. We named this particular presentation, Don't Waste a Good Crisis. So I really believe that, that's kind of what I've been doing, is raising money and waiting for the opportunities. And I think I've, been presented a few, and we're going to walk you through what I, kind of my mindset, how we evaluate, how we raise money. I think these are all the questions people kind of really always have. Like, how do you actually go in and raise $50 million? I mean, I hear people do it, but it's like, what do you do? Absolutely. What is the process, Nate? So we're going to show our slide deck and how we go about raising money, and show you, when we see an opportunity, when one comes through the pipeline. And keep in mind, we probably get 300-400 projects presented to us. So there is, with Chavis Capital, there is a method to our madness. So we're going to talk about that, how properties get into the pipeline, how they work themselves up through the pipeline, and how do they actually eventually get to me, for the final decisions, whether or not we're going to put a letter of intent. So we'll talk about that. How does the underwriting process look? What does that look like? What are you looking for? How do you underwrite COVID-19, in the middle of a crisis? We'll talk about that. And really, hopefully I'll touch on all these subject matters that are really timely. And that have folks scratching their heads right now. And then, of course, I'm always here for you guys just to answer any kind of questions throughout the presentation. So, Nathan's in control. So if anybody has a question, I'm not really good at reading on the fly. So don't type your question into me. Just interrupt me, and I do not mind as a presenter someone saying, "Hey, can you elaborate?" Or, "Hey, I have a question on that." So I kind of prefer that, just to let you guys know. Ask any questions. We have a limited time, maybe an hour and a half together today. So, I know I didn't have these opportunities when I was coming up to be able to speak directly to individuals that were practitioners. So take advantage of this opportunity that you guys have. Ask your questions, and really, there's no stupid questions, or at least we won't make you feel like it's a dumb question. So, we'll present it in a manner where we get you an answer.
Yeah. Hey, Bryan, real quick, folks, if you have questions, like Bryan said, he probably won't be paying attention to the chat. So send it to Yana and myself, and then we'll interrupt Bryan and ask them on your behalf. So the questions will come to Yana and myself.
Perfect.
Thank you,
Perfect.
Bryan. All right.
Yeah, great. Yeah, so just ask those questions away. So yeah, just there's nothing off limits. We got an hour and a half maybe. So let's jump in with that being said.
All right, B. So thank you so much for joining me in the studio today. How you doing today?
Man, I'm glad. It's always good to be in the studio, Nate. Anytime we can get here, we know we're doing something positive, right?
Absolutely. So we put together a 28-page presentation, a syndication guide. And this is the official guide that we use when we go in front of investors. And you kind of handpicked all of this information as you talk through it to investors. So this is not something that we're just put together for this presentation. You're going to see the actual presentation that we put right in front of investors to raise millions of dollars. And so what I want you to do, B, is kind of talk me through the process, why you chose these talking points as important talking points, and kind of share with us your mindset as you're presenting to investors. So we start with the introduction about syndication. Why do you want to lay the groundwork? You would assume that most people with all this money, they have a knowledge of syndications.
Right.
So
right.
Why are we starting with this?
Because they don't.
Okay.
Most accredited investors are very successful, and most that were in the particular room, when we created the slide, from Mark Willis to, some of his friends, some of them owned, we won't name any names, but some of them owned, large tech companies that we all know about.
Correct.
Shopping centers that we all shop in. It was a large group, but we can't assume that everyone in that audience, even though some of them were, one or two of them were billionaires.
Correct.
We can't assume that everybody really understands syndications. And then how is it applicable to owning and operating multifamily, and what their role is. So I think you always want to start with education.
Got it.
So
got it.
Then you get a feel for the room too. As you're laying down the groundwork, you get a feel for whether or not you got to pick it up.
Exactly.
Or slow it down. You know what I mean? So
yeah, there's been times where they're like, "Hey, get to the good stuff."
Right. Yeah.
But some people actually don't understand.
You'll read a room. Correct. And you always have to assume that they don't.
Right.
So
we put asking yourself a couple questions before you start raising capital. Are you purchasing a specific property, or are you putting together a blind fund? Why are those two important questions?
Well, for us, these when you're talking about investors and they're looking to do a blind fund, they know that they're going to give you a certain amount of money, but there's probably going to be a lag before that money is deployed. So, we want to ask these questions up front, or, let them know, hey, look, we can do a blind fund, and we do blind funds. And we also, find projects and raise equity for particular projects. I mean, for all of our beginning syndicators out there, it's probably easier when you're sitting with your attorney and your tax advisors. It's probably going to be wiser, even though the vast majority of people probably in this audience are going to look for a project and then try to raise money. But you'll realize once you actually build a syndication business, how difficult that is.
Right.
Because projects they're not a dime a dozen.
Right. Right.
And so it's easier to go the blind fund route. So then that's when you start flagging questions about the blind fund. Then you raise money. Then you're able to go out and look for opportunities and deals.
Okay. And then they're creating, so they can actually create the right exemption as well. And so you also listed a couple of exemptions. There's several exemptions, but we focus in on
Right.
506B and 506C.
Yeah. It can get very complicated really quick.
Right.
And this is part of that, trying to keep it simple.
Exactly.
So, we're pretty much going to do one or two of these exemptions in our syndication. So we're a C. And that's allows us to do the advertisement. So most people recognize, and I'll say his name because most people, know of Grant Cardone. When you're out there and you're very visible, you're obviously a C. So when you're selling and promoting your projects and things of that nature to the general public, then you're a C.
So you said you're obviously a C, but I've seen these Facebook groups where people are presenting deals and trying to, gather loads of investors. Is that also a C, or is that kind of they're walking a fine line of,
Well, you would hope that they fought for, a C, or, have some sort of legal representation. But yeah, primarily, you're going to want to make sure you have all your ducks in a row. So
Got it.
It's not only just being a C exemption, but all your paperwork, your PPMs, and we're going to get into that. But
absolutely,
there's a heck of a lot that goes into that. So you just have to be careful when you're out there advertising opportunities, deals, and talking about certain risks and returns. In putting yourself in the position as the actual, general partner or sponsor of that syndication, it could get, it can get dicey. So you just rather kind of,
And I asked that question because I'm a business owner myself, and I'm always about making sure that people are protected. And traveling with you for, over 6 years, we can see how it can,
almost 16.
Almost 16. Yeah. So how it can get really dicey, when people don't put the proper protections in place. Got it. Okay. Right. So once you have your legal team in place, you decided on the proper exemptions, you're going to focus on creating a PPM. Tell us more about a PPM.
So a private placement memorandum is our 500-page document, and it gives you, 600 reasons not to invest with us.
Right.
Basically, why investing in real estate is so risky.
Right.
So you want to be able to have, that's basically what a private placement memorandum is about. And you just want to have that there to protect both the limited partner and the general partner, and letting everyone understand, what's at risk here.
Right. I respect that. I see a lot on the inexperienced side. This is a can't lose opportunity, just, and so.
Yeah, then you're most likely gonna lose.
Exactly. So with syndications and with a lot of this stuff, you're kind of presenting a lot of the risk, but then you're also showing your expertise and how you're going to minimize that risk and how there's opportunity for.
Right.
Got it.
Exactly. So and that's actually a great point. If you remember when I was in front of this group, the one technique that I use is always talking about the 800-pound gorilla, and then always having, the solution to how we mitigate, including, right now, COVID, and speaking directly to that.
Right.
Is there a strategy in place? And then not only is there a strategy in place, is there a management plan in place that one can look at to see that you've addressed all these issues and that you're ready to go when you have boots on the ground. You close on Sunday and you have boots on the ground on Monday. What are we doing? So, having allowing them to see and understand that you have solutions and not just answers verbally. Because you're a great salesperson, you might, just because you dress up and put a shirt and tie on, it can answer questions. But to be able to show a management plan and some sort of, tactical plan on how you're going to, obtain the returns that you've advertised, it's really important. So yeah, the PPM that's what Melvin does. That's our attorney. His job is to put that. My job is to take that PPM, dumb it down, and address probably the major issues that they have about loss to risk. What types of loss due to market corrections, due to economic corrections, things of that nature. So those are some of the things that, right now are sitting and weighing on the minds of individuals. They know real estate's a good idea, but they're kind of, cautious. So I use it as an opportunity to address that.
Got it. All right. So now we're getting into partnerships. So we start to explain the difference between limited partners, general partners. And so limited partners, let's get into that. Why is this important to explain to your investors? And
Yeah, we want to explain their role.
Okay.
Most of the limited partners are always being pitched opportunities, especially accredited investors. So, these individuals are always being pitched the next latest and greatest opportunity. And then a lot of them are sitting on cash, to where their accountants are telling them, hey, listen, you got to put some money into real estate. And so, this is just explaining to that limited partner their role. It talks about, hey, yes, you're a silent partner, but you're still a partner.
Mm-hmm.
This is the amount of capital we look, our expectations of you as a limited partner, anywhere between 90% or 100% of the equity raise.
Mm-hmm.
What types of individuals we look for as limited partners are ideal, institutions, pension funds, family offices, high net worth individuals. These are the people that obviously that were in that room. That's our audience. And then, the fees. You always lead with the fees. Get that out of the way first.
Right.
So, you pay fees to the general partner, and then for exchange for expectations. And then you always should be able to figure out how to associate those fees and returns to, how you outpace Wall Street, or how you outpace other investments.
Got it.
Versus, risk, risk with a hedge against risk,
right.
and volatility.
Okay. And then, so now we have another partner. This is the general partner, the sponsor. So explain what that is.
That's us.
Okay.
Right. So that's Chavis Capital. That's us. That's, this now it's our role. We're the operator, limit. Sometimes, tell them, we put in a limited amount of capital. We go either 0 to 10%. We're our significant operating experience. Of course, this is when you're selling your experience. You don't want to go overboard, but because at this point they kind of already know who you are, but you just hit the highlights, the bullet points. And then, you talk about your sweat equity, you talk about your experience. And then, obviously we're the personal guarantor of the loan as well. And so you're really here at this point, you're just kind of really, this is an opportunity to speak about yourself, the elevator pitch, keep it, between, 10, 15 minutes.
Got it. Okay. And so now we're talking about general partner compensation and fee structures.
And this is where everyone gets, this is where everyone straightens up their back.
Money?
All right. This is where everyone straightens their back up. So if they're sipping coffee, they're checking their phone or looking at their text messages, when you hit fee structure, I'll be damned if everybody's eyes are not directly, on you. So this is where, this is where the rubber meets the road. So
absolutely.
This is always the fun part.
So as a general partner, when you're putting together the syndication, you're going over some of the fees that you can make. So as you guys are listening, what are some of the fees that you can earn putting together a syndication? I see you have them listed here.
Yeah. So, as a syndicator, if you do your job and you obviously know what you're doing,
right.
This is where you can make, 7 to 8 figures as a company. So, some of the ways that you generate that money, sometimes it's upfront as well, is through your acquisition fee. And that's usually 1 or 2% of the actual acquisition cost. Construction management fees, and we're going to talk about that and show you guys how those fees. And I'm going to show you everything. Right. So we're going to pull out my spreadsheet. We're going to get, we're going to show you this presentation.
Yep.
Then we're going to dive into a real life example that we're doing right now.
Excellent.
Asset management fees. So even if you subcontract out, so let's say I bought something on the West Coast. Obviously, I'm not going to be managing. Ideally, I would be, we would look at a 600-700 unit apartment building in California, San Diego. I would train the staff, but I would not actually be the property management company on site. So that management company, though, that team would report to your asset management team.
Got it. So
I guess in a sense, I'm never relying on third-party property management ever.
Right.
It is our systems. That's kind of what, the claim to fame to Chavis Capital is that, that all of that is in-house.
Absolutely.
But if you had to subcontract out property management, you as a syndicator still want to set up the operating or the management agreement and then hand that management agreement to that property management company and then tell them this is how you want the property to be operated.
Correct.
You don't want the property management company to dictate to you. You're the general partner. You're the syndicator. You don't you're not to be dictated upon. You need to say, hey, this is the management plan.
Right.
This is what we want. I don't care how much experience the property management company has. If I went to California, I'm on the West Coast, and I dealt with some of the, most successful property management companies. That's great.
Okay.
And I'm appreciative of that fact. But this is my property, and this is how we want it ran.
Right.
Because at the end of the day, the responsibility is with me. So I'm handing them a management plan, and if they're as good as they claim to be, then they're able to adapt to that management plan.
Excellent. Excellent. And then, so now we're getting into things like entity formations. Why are we explaining this to investors? And if you could just walk us through the process of how you form.
And that's a good question. It's funny how you mentioned that. It's like, why do you explain it? Because some people can say, that might be overkill. You got to be careful, right? Because you get too detailed and too granular. Sometimes, it's apt to turn folks off.
Mm-hmm.
But this is my personal experience, is that if you hit the right type of notes,
right,
especially with our audience, I think you keep it short and sweet. But I think what it does is shows the level of depth and understanding that you
Absolutely.
have, and so you begin to see how comfortable. By this time in the presentation, we're starting to see them loosen up a little bit.
Correct.
Okay, we're past the fees. Now we're starting to talk about how we're going to protect themselves. So it just lays out the structure of when Chavis Capital acquires an investment property, puts a letter of intent, we create an SPE.
Okay.
And then that SPE, depending upon that state, that SPE is then we, obviously set up the bank accounts for that SPE. And then, we want to make sure that the letter of intent specifically states that Chavis Capital can assign the contract to the SPE. And for those who don't know what the SPE stands for, it's single purpose entity.
Got it.
So you created an entity to own and operate that multifamily unit. And again, for us, it's layers of protection too. So, we can break that down. I don't know how much time we're going to have, but, when you're looking at various lawsuits from tenants or prospect tenants or what have you, even if you're a smaller operator right now and you maybe have a single family home or an apartment building, or a duplex, I'm going to tell you to create a management company and then create, an entity to own the property, create another LLC for the management company, even if it's you managing and doing everything.
Got it.
And then sign a contract between that management company and that SPE, that single purpose entity that owns your property. So you're adding layers of protection there in case a tenant sues you. They're suing the property management company because the property management company, i.e. probably violated fair housing law or violated whatever, slip and fall happened, sue the property management company. All you're going to do there is tap into the insurance policy, but you're shielding the protection of the asset itself. But then, this is where you have to be careful, because when you start these companies, if you commingle all the funds and put everything in the same bank account, right? Now a creditor is going to say, wait a minute, that's not a separate entity. That's basically a sole proprietor or an individual acting as a corporation, and then they'll still pierce your corporate veil. And or if they see that you have with that business account a debit card and you're buying, clothing or shoes or things of that nature, and say, wait a minute, that's those are actions of not a business but a sole proprietor, and then also pierce your corporate veil. So I kind of took a sidebar here, but it's important for individuals to also understand that even no matter what level you're in, that setting up corporate entities to better protect yourself is a really smart way to go about it.
Yeah, and it may seem like overkill, but I mean, we've worked with people. This could be a first-time investor that's now finally accredited. We have folks with self-directed IRAs looking to move money into capital as well, and so the level of knowledge varies. And from a high sophisticated level, they want to know, okay, yeah, if something goes wrong.
And it's when you say overkill, I'll tell you something that my coach used to always tell me is an ounce of prevention, Chavis, is worth more than a pound of cure.
Exactly.
So, for me, this helps us sleep at night. And then when you start getting into, let's put the train back on the tracks and start talking again, multifamily, multi-million-dollar deals. This is a must.
Yeah.
If you're doing a duplex, it's not a must. But for me, the reason why I decided to go off topic a little bit and speak to the smaller non-institutional investor is because it's better to start understanding this now and setting up these structures now, um, then, you know, to either do them after you've been sued once or twice, or, you know, to start learning this now as you start, you know, to step out there and try to raise, you know, millions of dollars and actually take down, you know, institutional grade type assets. So it's better to have experience of doing this now and learning how to do it the correct way from the beginning.
Exactly. All right. So now we get into understanding promoted interest. So you refer to this as a promote as you're talking, you know, so explain to us what promoted interest is, and why are you using this in the slide to share it with investors?
Yeah, and it's going to better come to light when we show you the spreadsheet.
Got it.
It's called a waterfall structure. But the promote is basically, this is what I'm promising you.
Okay.
So, you know, let's say if I promise you 7% return, I probably know I can probably get 9, right? So I'm telling you, you're going to get a 7% return, 8% return on your money. You know, the promote is, you put your chips in, I put my chips in. Let's say you put all the chips in 100, you get 100% of that profit up to the 8% return. Everything after that 8%, we might split 60-40, 60 to me, 40 to you. We might split 50-50. We might split 80-20, 80 to me, 20 to you after the promote. So, you know, it's how you want to set up that waterfall structure, but the promote is basically telling them, you know, what their interest is, what their return is on that investment. You know, and then you obviously have preferred returns, and I don't want to get too complicated for today's call, but
Right.
typically your preferred return is going to be measured against a discount rate.
Okay.
And so a discount rate is a rate that is used to measure when you're evaluating net present value. IRR is a similar, you know, again, I don't want to get too,
Right.
but the net present value, when you're looking at discount rates, looking at net present values, the idea is that you're taking future cash flows and and showing current value of what that would look like today.
Right.
So we all know $1 today is not worth is worth more than $1 tomorrow, right? So you're discounting those future cash flows. The reason why you need a discount rate or want a discount rate or have an idea of your targeted demographics discount rate is because, you know, you need that number to plug in. And sometimes if you're talking to a group of 5 people, you might have 5 different discount rates. One guy might have a discount rate because he has an opportunity, you know, or discount rate might also be called an opportunity cost. He might have an opportunity to do a project like a restaurant. This investor A might have that opportunity. They're getting 7%. Investor B might be investing in a bowling alley.
Right.
They're getting 5%, you know? So those are your various different discount rates. And you have to measure your asset against those various different discount rates. And that's why you should have, you know, a spreadsheet or your calculations to be able to help you with that. But everyone's going to have an idea in their own mind as an investor, what he or she can, you know, what they're doing. Sometimes it's, you know, it's just something as simple as what they're getting, you know, on Wall Street, or the T-bill.
Got it.
Or a bond. I'm sorry, not T-bill, but it's, you know, a bond. So, you know, they may not be a sophisticated investor where they have multiple investments. It might be in Wall Street. If everything's in Wall Street, obviously, then, you know, we all know then, you know, they're not getting much. So, you know, you don't really have to have an aggressive rate. So your discount rate really doesn't have to be. If you're coming in at a strong 7-8%, you're going to do well.
Right. Excellent. And then, so how do you end up finding partners? This is something that you share to investors as well. How do you go about finding partners?
I think everybody's doing it right now. I think you see, you know, you do it through education. You know, it's, you know, now it just becomes the point of who has, you know, the true content or education out there. But right now, I think, you know, for the most part, the way we've done it, the way I've always done it, is through education and training. That's how I was able to, you know, work with, you know, some of the elite of the elite. I mean, you know, obviously some of the people we had in that room, you know, well, and I'll name Mark because he's heavily involved in what we do. But, you know, to have a former CEO of Keller Williams,
Right.
you know, how did that relationship come about? Through education and training. I was a MAPS coach. I wasn't a real estate agent, but I was their only coach on, you know, property management and asset management. You know, and that's how we met. you know? And so even when we showed up here, this was more like an educational seminar that we did for them, understanding how they can make
Correct.
money in multifamily and what we called workforce housing.
Got it. Excellent. All right. And so evaluating opportunity versus risk.
So yeah, just as breaking down markets. We're using this to kind of, to give the example of what we're doing. Cause so now at this point, people are like, what type of projects, will provide these type of returns that you're talking about? What kind of areas are you talking about investing in? And this is where you start breaking down, what asset classes you're looking at. And, and you're also then breaking down and understanding, why you choose one asset class. Cause you might have, especially with this group, everybody's going to love the lure of new development. So a lot of the individuals are going to love Class A. We all know you can't build Class B property out of the ground. For the most part, most of them are going to be very attracted to Class A. So you have to kind of talk them into understanding why you seek C plus, B plus property. Why that asset class is more stable.
Right.
So this is where you have an opportunity to kind of break that down.
Hey, Nathan and Bryan, I'm starting to get several questions from folks to pop up. One question that came up was on the 506B versus C. Some folks have tried to get the PPMs and the paperwork from attorneys created, and there seems to be a huge variance in the legal fees for a 506B versus a C. And have you experienced that? I know you have a dedicated attorney, but in general, why are people seeing such a huge difference in cost for a B versus C from attorneys?
That's a good question. I'm not sure who answered, so I can't give the name, but address them. But I can't really address. I can tell you when I've always been blessed. It's kind of hard, for me I've always been blessed to have in-house counsel.
Mm-hmm.
And I've seen, and I've heard of this from other students and individuals that we've come across. I can't tell you why, to be honest with you, to be totally honest with you. And I don't want to, disrespect, obviously what our attorneys do for us, but it's a damn template. I mean, it's like, it's a template.
Yeah.
No, I mean, is it changing from deal to deal? 80% of it, no. 20% of it, yes, because it depends on what market I'm in, as we're about to segue into markets, what I look at. So when I break down and tell you, hey, listen, if I'm in Austin, Texas, or if I'm in California, or if I'm in the Carolinas, I might be looking at different asset classes. And so the PPM will change in that in that realm, in that 20%. But overall, 80% of it shouldn't change. So why someone would try, for me, it's just ideally, I think everyone's a capitalist. I think everyone understands that multifamily is a hot topic.
Yeah.
It's the same reason why the hell do we got so many multifamily experts now? Yeah. Everybody's an expert. Everyone is, has done, has got thousands of units, but haven't managed anything, haven't operated anything. There's a lot of noise out there. So when there's a lot of noise and there's a lot of movement in a certain area, you're going to see a lot of people take advantage. There's going to be classes and books are going to be written and so it's just unfortunate, but you just have to be very careful who you deal with. And, you want to, that's why groups like these are so very important, because individuals such as yourself are able to at least vet some of these individuals before they meet the general population. And so I think that's to me, I just think people are just taking advantage. I mean, I can only call a spade, and I can only speculate why it would change or why the pricing would change when 80% of it should really stay the same. You're basically talking about the risks of real estate specific to a multifamily project. So it's really going to be 80-20. 80% of it's going to be the same. 20% of it's going to change. And if you got more questions about that, I would actually direct you to our attorney, Melvin, who's in the multifamily matrix every week. and has his own segment once a month where he comes in and talks multifamily syndication. So I would definitely, reach out, get your free 1 month pass or 1 week pass to the Matrix, and use that pass when you feel and see whoever's on the list that you want to hear. If it's a special guest or if it's me or whomever, if you like, no, I want to wait till the attorney speaks, then use your pass then. And I would definitely recommend, joining, because you can ask these questions directly to the attorney and hear it from the horse's mouth.
Excellent.
Can you
And-
tell us a little bit more about the Matrix, Bryan, since you're on that topic?
I will, but I'd rather educate a little bit more. I'd rather finish the content, and then I'll slide us into the Matrix towards the end, if you don't mind. Jan, I just want to make sure I get them this content, and then I'll definitely speak and let Nathan kind of run us through the Matrix real quick, if that's okay.
And Bryan and Nathan, every now and then I may pepper you with a question that are coming through the chat. So
please.
Thank you.
That's what it's all about.
Thank you.
All right, so let's keep it moving then, B. So risk paths. I really like this area. We get a lot of investors because they are investors. They're so quote unquote sophisticated.
Right.
They have, hey, I got a 22 cap rate. I got this property that I want to invest in. Let's go for that. And we have to kind of set the record straight of what we're actually going after.
Right.
So you have this risk path that you share with investors. So tell us more about risk paths and break this down. What is this? What are you talking
So
about?
it kind of explains, like, hey, listen, if you're in a core market, this is what you can expect. If you're in a core plus, this is what you can expect. If you're in Austin, Texas, this is what you can expect. If you're an opportunist, this is what you can expect for your returns, but these are your levels of risks. Mm-hmm. So it just kind of breaks it down. Is it the gospel truth? No. But it just gives you an idea. If we're in a core market, we're in downtown St. Pete, right, like our projects, and this one that we're going to show you as an example, don't expect a 15, 20% cap rate. You're not going to find that. Right. You're not going to find those, 22% IRRs. You're not going to find that in these core markets. Mm-hmm. But what you will find is stability. Right. And see, beforehand, I was explaining stability when we were in Texas before COVID-19, and I was saying there's going to come a time when you're going to want to invest in multifamily, not just for the returns, but for the safety and the security. Yeah. And if you remember when I was because it's less volatile. Right. And then COVID-19 comes along. Of course, I'm not trying to say I predicted. I was speaking on terms of a recession. Right. Because I was looking at the inverted yield curves. Right. And I was predicting recession. Didn't predict COVID-19, but it's still, it still basically supports what it is and why I'm saying, hey, listen, there's certain markets that I'm targeting, mm-hmm, and there are certain returns that I'm targeting. I'm not necessarily attracted by a 22% IRR, right, 17% cash on cash return because on paper, because, when you get those higher returns, you can expect more risk. And right now, ask folks how they're handling it. There's a lot of folks right now that are a lot of material that you see, a lot of regurgitation. Individuals saying, oh, multifamily is doing so well. Multifamily actually weathered and fared better than what we expected. Wait until October, November. Wait until October and November. Why? Because, what you're seeing is and I'm telling you not what I heard, I'm telling you what I know. You're seeing a lot of the tenants use their credit cards, unemployment and stimulus. When you see these savings, or by October, November, a lot of these things are going to run out. The unemployment, the insurance that they have on these unemployments in certain areas in certain states, running low, mm-hmm, having to go to the feds. Right. So you're going to see unemployment kind of bottleneck. People are going to, you'll start to see a little bit more of the turnover. And then when you see a lot of the investors who have leveraged and used a lot of leverage to get those returns, mm-hmm, this is where you're going to see the imbalance. This is where you're going to see a lot of these loans move into out of that forbearance. You're going to see a lot of these loans move into LCC, special services, correct? Loan special services, and then move into foreclosure. And then this is where I'm predicting how the banks are going to react, because banks are in what's different between 2008 and where we are now, Nate, is banks' balance sheets weren't that healthy back then. Banks' balance sheets are a lot healthier. So the question then becomes, Are they going to be more apt to foreclose or be more apt to work with you because, you know, they're in a good position? My take on it is it depends on the asset, the location, and whether or not it's graded as an institutional grade asset or not. Right. So if you're falling in as a smaller investor between 20 to 80 units, right? They may not be so they may be more willing to go ahead and foreclose if they're not confident with you as an operator. Right. You know, so, you know, if there's no documentation being provided to the bank that shows, hey, listen, here's a new management plan. This is how we're going to deal with COVID-19. Like if you remember how I changed my qualifying criteria, we changed our management plan, right? If you're not able to present that to a bank and show them that, hey, look, I'm not, you know, we're not just talking. I've given you a detailed explanation of how we're going to address COVID-19. Here's our stimulus package for our particular tenants. If you can't really show that, the banks might lose confidence. And there's not too many people who are doing that because they don't have those skill sets. No one's learning those skill sets. It's all about investing in multifamily and getting rich. And this is working with investors, underwriting courses. Everybody's got an underwriting course. You know, that's the fun part of all this. Right. But the hard work, no one wants to talk about. No one wants to do. But this is the hard work is what really allows what we do to get in front of this type of audience and be able to raise the millions of dollars. People can care less about the fluff at this level. They're more interested in, do you really understand like the work that goes into this?
Exactly. Well, I want to simplify this real quick. So this is a traffic report. So these are fictional depictions of what we consider the different markets. We're explaining our language to the investors. So we have core plus, value add, opportunistic, and we're focusing on core markets. And we can focus on any area, but there's a difference in this green core market and the level of trouble that you'd have with this type of tenant, this type of market versus the red.
Right.
And so some of these guys, they're pushing for these high returns and 22%. What does that come with? You know,
risk.
Exactly.
Risk.
Okay.
Risk. And if you know that and you're comfortable with that, that's fine. And if you know how to handle it.
Right.
People, you know, if you are a great manager and you understand asset management and operations, then that's fine. The number one thing that everyone in this group on this call have to understand is that the number one skill, the most important skill, is the property management skill.
Right. And so with this 6 to 8% return, you're going to get investors saying, I can get those same returns elsewhere. Why are we choosing to go with something at 6 to 8% return?
So, good question. So one of the answers is, let's talk about real quick IRR.
Got it.
So in IRR, you can have, a lot of folks don't understand the true definition of IRR. So you can have an IRR, Nathan, that if you have an investment, to keep it simple, investor A and investor B puts in $200 and investor A gets $150 every month for 10 years and then $1,700 at the end of 10 years, they can have something like a 17% IRR. Investor B puts in $200, gets absolutely zero for 10 years, and then gets $20,000, right? Yep. At the end of 10 years. Their IRR is going to be 17%.
Okay.
But those are two different returns. One is getting like $1,700 or $1,700 something, you know, I'm getting like $1,700. Yeah. The other guy's getting $20,000. They're not really comparable, but they both have a 17% IRR. So the question is, what is really IRR measuring? IRR is measuring the efficiency from which you get that money back.
Got it.
So if you remember net present value, discount rates, and all the things we talked about, it talks about future cash flows. Right. You want to look at an investment that's giving you back your money the quickest. Okay. There was a post on Facebook where the baseball player, Bobby was getting money. Yeah, was getting money from there. And they made the post look like he was a genius. And I'm not saying I know all the particulars. Okay. But I'm just telling you the way it looked to me. He's getting like $1 million for every year or something for 30 years of the rest of his life. Mm-hmm. But as it was presented, that's not really a deal. Mm-hmm. Unless, you know, show me unless he's getting that $1 million plus his interest. Mm-hmm. If I'm deferring your payments for 30 years, you're not getting $1 million. You're actually probably only getting someone like maybe $450,000 when you add inflation and the time value of money. So you got to understand, if he didn't negotiate and say, if you just say, hey, listen, we'll give you $1 million for the rest. No, what you'll do is give me $1 million, but you give me 15% to offset inflation. Because when you look at your numbers and you look at IR, you'll notice that $1 today is worth more today. If you take those future cash flows, they get weaker and weaker as further as they go out. So $1 2 years from now might only be worth 30 cents. So that's where you're talking about, hey, man, I'm looking for this return. I'm looking for that return. You're not only looking for returns, you also want to look at cash multiple. You want to look at net present value, and you want to look at IRR. So there's more than just one thing you want to look at. And so what multifamily does is says, yeah, you might get that 17% return on paper, but I'm going to get you probably a slightly lower return, but I'm going to get you a much more efficient return with less risk. And that's the pitch.
Got it. All right. So
in multifamily.
And so throughout our presentation, once we explain what risk paths are, we kind of just show examples of what they look like. So a core market's going to look something, these are just hypothetical examples,
right? Yeah.
As you move through the list. And then, so our underwriting process. So we go into a 4-step underwriting process. Tell us more about that, and why are you explaining that to investors?
Just so they understand that there is a process to this.
Okay.
That we're not, not even I. If you think that I'm looking at these deals and I'm just doing all the underwriting, I've always said, if you're the smartest person on your team is in trouble. Mm-hmm. I'm clearly not the smartest underwriter. I mean, I can't stand numbers. Not only highly dyslexic, but I just, this is not what, I know you see a lot of folks love the underwriting process. Mm-hmm. It's not a process that really gets me overly excited. So I always want to make sure that I measure twice and cut once.
Right.
And so the process for us, it goes through, the project comes in, it gets evaluated by, a team, much smaller team, 1 or 2 individuals. If they like it, it goes to junior underwriting. Then from junior underwriting, senior underwriting, then from senior underwriting to the director of acquisitions, and then it's reviewed by myself, the director of acquisitions, the senior underwriter, sometimes the junior underwriter, maybe 4 or 5. We allow 4 or 5 of our interns that are in our coaching program, are in the multifamily matrix, to listen in. Right. You might even seen one of those meetings the other day on Facebook that I did. And then if I like the deal, we're confident, then we move to LOI, from which we're going to kind of show you guys.
Got it. All right. And then we talk about our investment memorandums, all the things that we include in a memorandum as well.
Right. Just capital rate. These are all the fundamentals, and we can share some of this with everybody. What I want to kind of do now is possibly, no, well, yeah, we can finish this. We'll finish this, Nate. But I'll show the LOI, and we'll show what we do and how we bring this to the crescendo.
All right. And then we have our funding process as well. So we explain to them the funding process.
Right. Correct.
Got it. And then
and if we go back, want a bullet point, the funding process is really important because of that 7-day timeline. So when you guys are out here raising money, especially if it's project specific, remember in the beginning we talked about blind fund versus project specific.
Right.
When it's project specific, that 7 days becomes crucial.
Okay.
Trust me when I tell you, you got 10 people saying that they want to invest in that project that you got. That really means you got 4.
Got it.
Think about it. What I just said before we jump to the next slide. If you've got 10 commitments and you're on that 7-day timeline, it really means you only got 4 commitments. That's how you got to think of it.
Right.
So you always got to be working and raising money. Don't ever think that you've got enough, because people will back out within that 7-day time frame for whatever reason and leave you holding the bag. So you may only have 1 or 2 times with an LOI out there with a certain amount of certain groups before people say, oh, these guys don't pull the trigger. So, you might stop getting deals, and, especially if you're relying heavily solely in the beginning just on commercial brokers, they're going to only really want to work with people that they feel are going to be able to get the, get the horse out of the stable, one, and then across the finish line.
Yep. Excellent. And then in this section, we really just talk about how investors expect more of an online experience these days. Right. They're familiar with Amazon. They're familiar with all the apps. So we've taken the time to create more of a streamlined syndication process. So we use our own software to, put them into our system where they can evaluate their deals. They can see the performance as they're going, moving forward.
Yeah, and that's the most important thing, is just
Correct.
being sure that you have a platform that they can go to, see the deal, see the offering memorandum, download it.
Correct.
And if they invest in your fund, they can put their K-1s in and all their tax information. They're able to download their reports, their monthly reports. They're able to access the PPM
Correct.
documents, everything that they need to sign, the wiring information on that particular project. Everything is within this platform. And yes, we're partners with Syndication Pro. So, all of our members are able to have the same platform and white label the same platform, which is really cool. Excellent. So it gives you that level of sophistication that you need as a syndicating business.
Excellent. And then, we just talked about our SEC compliance, and then also our in-house operational excellence. So, our property management staff is professionally trained. We partner with best-in-class services. Each property is managed by a certified property management specialist. And then so your book is in the U.S. Library of Congress. So Buy It, Rent It, Profit is the only book on property management in the U.S. Library of Congress. And so, we try to just show the level of expertise.
Right. You close with that.
Yeah, exactly.
You want that. Yeah. So you want them. The last thing you want your audience is to understand the credibility.
Absolutely.
So they feel at ease.
Absolutely. And then we talk about the exit strategy.
Correct.
We, kind of sign off with the exit strategy, make sure they understand how they're going to be paid, how we close out the deal as well. And that's that, B. So what would you like to share now?
It would just, maybe pop in and, before we show, I know Yana was on me to make sure we show the matrix. So we'll do that. But I just wanted to kind of just show people what all this looks like, because it sounds really great when you read it in the book and it's on paper. But then, what does it really look like? So this is an offering memorandum of a project we're going to take down in downtown St. Petersburg. I don't know if this is the offering memorandum. So what I do is, of course, you go through their offering memorandum. For the most part, this is just for you guys. I'm just looking at the pictures and I'm waiting to get in there. Most of the stuff that's in the offering memorandum, I already know, because we've done our COTA process, strategic evaluation of a target area. So all this information I kind of already, I'm really not even looking so much at what they put in the offering memorandum. I'm just really looking, kind of going through the pictures. I'm really after the T12s and the rent rolls, and really after the rent roll. Even the T12 sometimes, really don't tell the story, but it gives you a good idea. But at the end of the day, we're building our own financial model. So, their T12s are important, but we're also building our own financial models, because everybody manages an asset a little bit differently, especially at this level when you're dealing with units under 100. So you deal with a lot of non-institutional investors. Everybody's going to have their own way of handling their books.
Excellent.
So this was what an offering memorandum would look like. I'm basically, the most important thing out of the offering memorandum.
Is this hypothetical, Bryan?
I'm sorry, say that again, Yana?
Is this a hypothetical offering?
No.
Okay, let's fast forward past this part.
Okay.
All right.
If we can just jump into the multifamily matrix, because we only have about 30 minutes left, and I want to save time for Q&A.
Okay.
So real quick, B, as you can see, this is a level of expertise in a real life scenario. So we've shown them how we actually take down deals. We wanted to create an educational platform for other people. I want to let's segue into the matrix. Why did we decide to put together the multifamily matrix as a resource for other investors?
Several reasons. I think the number one reasons for us was the training and education. Where could you go to actually get true certifications, designations in multiple aspects of the industry, whether it be underwriting, property management, asset management, maintenance,
right,
legal, marketing, branding,
right.
All this stuff that we're talking about, that just in the talk that we've just did, we've talked several areas. We've talked underwriting, we've talked branding.
Right.
The presentation was just as much you as it is me.
Absolutely.
My information, your branding, that has to work together. If I came there with a bunch of, note cards with all that information on there, I'm not raising any money.
Correct.
So, So we talk all aspects of in entrepreneurship as
Right.
well, self-development.
Right.
So having all these courses and training, on a learning path was really important. So not just having a place where we threw it all in, and then had live coaching sessions and masterminds, but a place that really, provided you a learning path that allowed you to know, depending upon your skill sets that you identify in the beginning, it put you on the path and you were able to take that training,
Right.
and take those courses. So the first course might've been business development, then it moves into asset management. Then it takes, property management course. Then you're taking an underwriting course. It moves you along a path that, that for me, I thought would never end because you're always constantly learning. And so where was a place like that? Obviously you can go to a university and even then there was an end, right? There was an end of the semester when you graduated, I wanted to create something like that, but it really never ended. There was always new certifications. There was always new learning modules. There was always new coaching sessions, always new guests you can learn from. Where was that place? So it didn't exist. And so we built the Multifamily Matrix.
Absolutely. And so this is a private community for investors, for syndicators, for anyone that works in the multifamily industry. We meet once a week. We have live masterminds. So similar to what you heard today, we talk about this stuff every single week.
Correct.
We went over this. So in the Matrix, you're able to see real life, LOIs and offers being put together. Other investors have deals as well that they bring to the table. We did a 500 unit complex. So we did a consulting job for a 500 unit complex just about a month ago.
Mm-hmm.
And so all of the members were able to either watch virtually or some of our members actually joined us on site. So there's plenty of opportunities.
And then that information is canned into a training course from which has a workbook. And so, another thing that I mentioned in the Matrix is that every podcast that we've ever shot gets canned and turned into an educational, course complete with its own workbooks. So even when we do a podcast, we're guaranteeing that our members are going to learn something. So, you're not just listening to a podcast, but now you're actually, having to do course exercises and there's a training within that podcast. So just even, just knowing that even every podcast that we have shot and then are shot, filmed, recorded, now and in the future will always be, it just shows you how much training and knowledge is, that's in the Multifamily Matrix.
Correct. So we have over 130 pre-recorded videos that we put together and created learning paths for you guys to be able to become professional, multifamily practitioners. You're going to be able to get your certification as well, become a certified rental investment specialist. And then you have access to Q&A sessions, membership pricing on different products and different events that we have throughout the year once COVID actually, steps away. So it's a great platform if you're looking to get into multifamily or if you currently manage properties. All of your forms and resources are available to you as well. So you have access to forms and access to expertise. So we have syndication attorneys inside of the Matrix as well.
Got everybody, maintenance men, syndication attorneys, everyone that is a part of the industry.
Correct.
We're going to have certifications for each level: maintenance, legal, underwriting, finance, accounting, management, budgeting, asset management. So certifications for every aspect. And then, we'll be doing an unveiling. Right now we're just showing them almost like a funnel of the, not the actual site, but more about that when we're going to be doing the actual unveiling. But if you want to talk to them about that or even show that, I'll let you. I'll let you.
Yeah, absolutely. So we've been running the Matrix now for quite some time, and we've taken it to the next level. So we've actually rebranded the Matrix. You'll probably see the logo behind Bryan as he's speaking. I'll go ahead and share with you the new version of our site, our 2.0 version. Let me go ahead and pull this up. You probably already see that. So,
and I shared a link to everybody in the chat if you guys are interested in taking a look afterwards.
Absolutely. So So you guys, we just wanted to give it a bit more professional skin. We want to compete with the National Association of Realtors. Make you have something that you guys are proud to, use the logo, use it in your literature. So this is our new Matrix 2.0 version, and so we have our learning path in here. We have our library, our community. This is more of like a social network where you can actually talk back and forth with other folks. So as you're going through the actual course, you can speak with other investors, become friends with them, talk to them about different deals and different projects that they're going through. So you'll see here, all of your courses will be listed in here, any certificates that you earn, when our next live session is, our newest podcast, any announcements. And so we've got everything in here for you guys. Just a full,
So
library.
you go back down and kind of explain, the path. So here you see the
absolutely.
learning path. Within that, you click on that learning path, and that's going to give you the 3 subcategories.
Correct.
And those subcategories are all hundreds and hundreds of courses based on the entrepreneurial fundamentals that you'll need. So self-development, with some of them will be how to prepare yourself, credit, how to prepare yourself, legally. So a lot of the legal stuff in there, the entrepreneurial fundamentals, creating corporate entities, and a lot of that section will be Melvin's, and then you're going to meet skill building certifications. Then you get into your property management certifications, your you're evaluating multifamily markets. A lot of your underwriting and your finance courses are there. Your due diligence process, tons of courses on due diligence and certifications on due diligence and how to perform, due diligence, not only on the property, but, one prepared for the lender. And then industry fundamentals, apartment syndications. So all your syndication courses, almost like what we did today, but in much more greater detail, your certifications and designations in there. Contracts, negotiations, and purchase phase, and then property analysis and financial evaluations. And then you're also able to grab tools, which is really cool. So you'll find spreadsheets, some of the same spreadsheets that, I didn't have time to take you guys and show you our spreadsheets today, but you would be able to access the spreadsheets and things of that nature inside there. And remember, so we'll also have related videos in there as well. So, whatever podcast we've ever done on those particular topics will be in there along with the workbooks. So it is, you won't find anything in greater detail on a particular subject matter, like you will here in the Multifamily Matrix.
Correct. And so, all of these resources are available for you. So as you go into our courses, each course will take you through, you just complete one course, move right on to the next. You can take them however you want, but we have a learning path laid out for you to help you make sense of everything. But as you go through, you can see you've got all of this content.
You can download your certificates.
Yep. And these are all video-based and podcast-based. We also record our videos as well. So not a bunch of text that you have to read. We do have workbooks as well, but you can watch the videos and learn with Bryan himself and us in the studio. So we put together a really massive community for you, not only to learn one-on-one, but each week you come together with us Thursday nights, 8 p.m. Eastern, for mastermind Q&A sessions. Talk to us about things that you're working on. Ask questions about deals that you're looking at. Bounce ideas off of other investors. So it's a great network. And the best thing about this is the price. So all of this education and training, what's the price for this?
Probably your Starbucks budget for the week.
Right.
Now, I mean, it probably used to be your Starbucks budget for the year, but yeah, we've got it at was it $59 if you want to show the pricing. But yeah, it's very affordable. So it's your Starbucks budget for the week.
Correct. So we have starting out at $59 all the way up to $149 for a larger package. But each week you'll be able to access and take all the training. So as low as $59 a month. We have our $100 a month package and $149. So by joining the Matrix, you're going to be in a great ecosystem available to you guys. And it's just a great resource for your education, and we're here to support you guys moving forward.
Absolutely. I think before we turn it over to questions, the coolest thing is that it's never gonna, hence the name Matrix. It will never end. There's always going to be new The cool things, we're collaborating with partners who are also providing educational content for us, from which then we vet and then we send through our process of creating the workbooks and the trainings. So, I mean, we're always gonna constantly have training within the matrix that our members will be able to have access to. So, yeah, so if you want to become a student and a master in skills, that master these skills that are important to be successful, and map out the lifestyle that you want, this is where it starts.
Yeah, and so I just want to speak to this page right here. So I noticed that you have your weekly call, even in the lowest package, which for me is a huge benefit because there are a lot of things that you can buy, you can sign up for. They're all web-based. You have to take the modules. You can't really confirm your understanding. There's no one to reach out to. But even when I was a student of this multifamily matrix, one of the most valuable parts of it to me were the weekly training calls. So the fact that you're offering that in the first step and not the highest package is a huge benefit. Just having live access. And when you said this was a 2.0 version, since I'm no longer a student, I thought that you would have taken that out, but I'm glad to see that it's still there and that people can still access you live.
Yeah, well, I mean, I think that's the most important thing is as we were beta testing it and getting an idea and having individuals like you in the group, when we started out with 1.0, if you want to call it 1.0, that's kind of why we did what we did. Had a lot of the various different individuals from various different backgrounds start with us and give out a free scholarship, was to be able to watch and see how people interacted, how they learned. Because I mean, I can have all this information, have gone and have it all in my head, but just because you know a lot of information doesn't mean you know how to disseminate it to the masses. And so for me, the most important thing was to start that focuser group that you were part of, Yana, and get views from all walks, everybody, and understand what people were really after and how they actually learned. And then taking that information, what do we do with it? You study it, and then you begin to build around it, and that's what we've done. And so, yeah, that all this is a reflection of that process of what you went through for 3 to 6 months as we were beta testing this. So yeah, so and it's going to continuously, as people change and as their needs change, we will change. That's the idea of the matrix, that it will never, it's how Bruce Lee talked about being fluid or water. It would put us in the teapot, we become the teapot. That's what this is really. If the market changes in one direction in multifamilies, you're dealing with COVID-19, you're going to find trainings in there about that. It's going to be able to be extremely fluid. One day I'd like to be able to see where, my kids are going to be able to come in here and take lessons. It's just going to be something that, it just will continuously evolve. It will never, stay stagnant. So
Good to hear. So do you feel like somebody has to have prior investment experience to jump into multifamily, or could they just start here? What's your recommendation? Is there a prerequisite for this course?
Oh, it's no course. This is not a course. This is like if you enrolled in going to the gym. You wanted a better body. What does a better body look like to you? I mean, to some people it might be chiseled. Some people it might be just, where you can't really fit into your clothes, that kind of look. Whatever that look is that's whatever you want. But you got to start somewhere. You come to the gym, you got everybody with different ideas of what it is they want, but everyone wants good health. Everyone wants to look a certain way. Everyone wants to own multifamily. I don't know. Is it a duplex? Is it a quad? Do you want to do large syndications like what I'm doing? I don't know. But this is where you start. This is where you gather the information. Where is the knowledge? Where is the place where I can go and study and grab all the archives? That is what the matrix is. It doesn't matter what your beginning is. It doesn't matter even your level. If you're a heavy hitting syndicator right now, you can still brush up on your asset management skill sets. I don't care how great of a syndicator you are. You can still understand how to maintain and operate your properties better. You're going to find courses in here on that. So it doesn't really matter your skill set. You come to the gym to get results and to get a better way of life. And that's the kind of way I feel you should approach the multifamily matrix. You should just come. You just just show up.
Okay. Let's try to see if there's any questions out there. Does anyone have any questions?
Yeah, I'm getting a few questions. So there's
Okay.
one on Bryan and Nathan. There's a lot of kind of news around COVID. I think you covered some of it. How do you, and I'm glad you had that one kind of a traffic signal, kind of a, San Francisco, Miami, Dallas, maybe Florida markets. But how are you preparing? I know you had mentioned the recession. There was going to be some kind of an event. We didn't know what that event was going to be. And I'm kind of like with you. I knew things were just too good to be true, maybe 6 months ago. And everything was hunky-dory, but I knew that there was going to be some kind of event, and a recession, maybe a small war or something. But no, I think almost nobody predicted the pandemic. But how are you preparing for trouble in some of the assets that maybe some novice operators had picked up with the expectation that they could just simply raise rents and kick people out and just improve their NOI and just go refinance? What are some of the challenges that they're going to run into, and then how can savvy investors maybe take advantage of that scenario?
That's a great question. So right now, I do not have all the answers. I've said it in our sessions that it's a 90-day hold period. And since the very first time that I said it's a 90-day pause and evaluate for me, it's probably been about 60 days. So I'm still very, my belief is I'm going to have a clearer picture in October, November. With that being said, what am I anticipating? I'm anticipating, or I'm studying, I'm looking at, obviously the debt markets, capital markets. I'm looking really at employment to really keep this simple. I'm looking at employment. I'm looking at what industries are being affected and what industries will be affected, what industries will not be able to bounce back. Things are going to change, guys, no matter what. Things have already changed. Things are going to continuously change. I'm looking at, everything, how COVID is impacting our industries. What industries do I think will survive? What industries do I think are going to go away? All this is going to change the demographic and psychographic profile of my prospect tenants. So right now, just watching and seeing how some of the industries adapt is, what I have to see to be able to then start helping you all and forecast and give you my opinions. So I'm watching what industries are stepping up and making changes. I'm watching how Disney opens up. I mean, that's huge for Orlando. That's our tours. That's everything. That's everything that really supports the Orlando market. So, how they open up is really important. It's not just, everyone thinks on the surface that they just open up and they're just trying to make their money. It's more than that, because they understand if they get this wrong, that, it could have a huge impact moving forward. And so, we have to be quick, but we can't hurry. And we have to see what technologies are being introduced, which is going to create new fields and new opportunities.
Yeah.
On how people are screened when they come into these parks. Are their temperatures going to be automatically taken? When, the fingerprint that you put in to get into Disney or in your area, Disneyland, will that now read and take heart rate and temperature and things of that nature? Absolutely. Are they going to have a mist that blows out in certain areas that kind of like fumigate, or is there going to be an infrared light that you kind of walk through and you don't even know you're going through it when you're entering in rides or exiting certain parts of the park that are kind of cleaning you bacterially? I don't know. But these are the things that I'm watching, because these are the things that are important. These are the things that are creating industry. And this is what's going to change the demographic, because certain jobs are going to go away, Bobby. Yeah. Certain jobs are going to stay. So it's my job to kind of forecast and understand and look at those demographics and what psychographics and what impacts they have based upon the assets that I purchase, in that particular demographic who rents from me. And so you're going to see things change. And then right now for our current operators, there's not much you can do. You're probably going to catch a dropping knife. If there's some techniques that you'll need to focus on, it will be changing your qualifying criteria. You might have to loosen your qualifying criteria. You might have to work out your own um, forbearance with a lot of your tenants and understanding how to finance. I just had to do that with one of the tenants that used to make excellent money, Bobby, and as a waitress in the downtown area. She lost her job. She got back to work. Then they shut the bars down, took the alcohol away, shut the bar down. She lost her job again. And so I had to extend her lease and basically finance her lease. I extended the lease, and then I added, an extra, gave her a month, this particular month, a credit for this particular month, stacked it on the back end, but then raised her rent slightly after next month, maybe $10-15 until that 1 month free that I gave her is paid back until her unemployment kicks in, things of that nature. So you're going to have to get creative. You're going to have to change some of your things in your qualifying criteria as a current operator. And what I mean, your qualifying criteria, how you evaluate that particular tenant when they place an application in, as far as, the security deposit that you're offering. If they're coming from the service industry, you're going to probably need a little bit more documentation on their hours. And then you probably ask for, if they're coming from the service industry, a deposit equal to rent. So there's things that are going to have to change, as an operator right now, qualifying some of our tenants. So again, I don't really see a lot of individuals having troubles with delinquencies right now and turnover because a lot of the states have paused evictions. So what that has done has really, created a situation to where you're not seeing a lot of people skipping out, or a lot of people, moving in with each other. You're not really seeing a huge uproar on the management side at the operational level because of some of the things that are going on right now. But who's to say you won't, in October, when when people start running out of their savings and unemployment is not as readily as they thought it was, or getting their checks to them. So stimulus runs out. So these are all the things that you have to think about as a current operator and plan for. As a guy on the sideline with a lot of dry powder ready to deploy, you're going to have to do you're going to have to, change the way you underwrite. You're going to have to understand that debt coverage ratios are going to be slightly higher. Insurance is going to be higher because they're going to have to try to back in COVID and some kind of virus protection.
Yes.
So your insurance rates are not going to be where they used to be. So, how you underwrite these projects moving forward is going to be extremely important. I'm just giving those two examples because I know we don't have a lot of time, but there's a ton of others that I could go into in the due diligence process and the underwriting process, and things that I'm having to look at moving forward in underwriting. So, and the problem is that sellers, they're turning a blind eye to what's going on. They're basically confident in their net operating incomes, whereas I'm probably not so confident that some of these net operating incomes are going to look the same. These cash flows will look the same as they do right now this time next year with a lot of these properties. I think some of this will dry up slightly and bottleneck, which will cause, you would think if you're buying on an income approach, it would cause the values to do what? Go down. But if a real estate, or if an investor is or a seller is unrealistic and continues to put pricing out there based on pro forma and not actual, historicals, then then this is where you'll have a standoff. The problem is, especially with assets that are under 100 units, there's two type of buyers right now: really smart buyers and really dumb ones. The really smart ones got $50 million, so they're saying, "Listen, I'm going to buy that building cash, right? Because if I leave the 50 million in the bank, the IRS is killing me. So I need to deploy it and have write-offs, right, to get the tax deferrals. So they'll buy it cash. That's why the sellers are still saying, and the commercial brokers are telling them, no, price it at this price. We'll eventually find someone. And then you have obviously the really stupid ones who are not doing their homework, that are just buying, and then find out, on Monday when they have to show up, that they're not able to capture those rents that they once thought, or those Airbnbs that they thought they were going to generate income in are no longer generating that income because Airbnb in the state of Florida was shut down for whatever reason, or Austin for whatever reason. So these are the things that you have to kind of just this is why the matrix is important. It's all ongoing. It's not a fixed It's not like having a fighting opponent where that opponent has a fixed style.
Yeah.
I can do a little bit of homework on them and kind of know when I'm stepping into the ring, what I'm dealing with. This is an opponent that has multiple styles. So, it's kind of difficult to be able to, that opponent, you've got to be just as fluent, and you have to be just as skilled to be able to keep up with their ability to change, techniques on a drop of a dime. It's why boxers who can change from southpaw to conventional, reap havoc on other boxers, because the style change is very difficult to adapt. And it's kind of how I look at the market. It's like, how do you adapt? And you have to be really skilled to be able to adapt in a market like this. And that is why education and training from true practitioners in this industry is so important, because you cannot falsify skill sets. You can't make that up. You can't go and buy that out of a book. You can't join a group, no matter how compelling it is. And this stuff doesn't just grow on trees. This is stuff that you actually have to learn.
Yeah. So, and the matrix ideally is for people that are just looking to improve their knowledge of the multifamily space, and maybe potentially, maybe they're limited partners, maybe they're GPs, future GPs, future LPs. Who is it really targeted for?
Anyone who wants to own and operate one-day multifamily, anyone at any level. You might start off with a duplex. There's guys in there that are just starting off with single-family homes that said, what, the single-family home thing is, I'm learning that I can benefit from the economies of scale. But to me, doesn't mean 100 units. That means just maybe going from single-family homes to a duplex and quad, and then learning how to build from there, developing a model, and then that model attracts someone with more money, and then those two people partner up, and then you go after a 40 or 80 unit, and then their process begins. So it's there's really no limit to who you are. It's just, I decide that through multifamily, and that doesn't mean you have to be doing something at an institutional level, but you've made a commitment to yourself and said, listen, I'm not going to flip. I'm not going to wholesale. I've done those things. They've done well, but they're very cyclical. I want to get involved with multifamily, something that creates wealth, because you can get rich from wholesaling. You can get rich selling houses. You can get rich developing. But the multifamily matrix is not about getting rich in real estate. What the multifamily matrix is about is creating wealth. And there's a big difference between being rich and being wealthy.
Yeah.
That's about all I got to.
Yeah, no, thank you, Bryan. Thank you, Nathan.
All I got.
Folks, if you got any other questions, I know we're kind of coming up on our time. Feel free to chat, use the chat button in the bottom. Otherwise, thank you so much, Bryan and Nathan. For the folks that maybe have another 10, 15 minutes to kill, I do want to demo a product that I've been working on myself, and would love to get everybody's feedback. I'm looking for beta users for my platform, but if you still have questions, feel free to send in the chat. Yana and I will stick around, but thank you, everybody. Like I said, if you got time, let me know, and I'll do a quick demo. All right, I'll assume that some of you are going to be able to watch what I have built. So give me a second here. So I'll actually log out.
Hey, Bobby, I'm so sorry. I actually have to run. I didn't know that.
No problem.
I'm going to jump off. Thank you, everybody, for joining.
Thank you. Thanks, Bryan. Thank you, everybody. So folks, real quick, I've developed a tool for people to track their assets. What I mean by that is more than just an Excel spreadsheet, right? So it's called bettercapital.us. And what it does is I'm going to log in here with my Gmail. So I'll just pick a property here. Let me see here. I'll log in with this. And I'll show you how to add a property, but I'd love to get your feedback. We're in beta mode right now. So I'm going to use a sample property. This is my demo property right here that I use. So right here. All right. So we're going to pick this address.
Hey, Bobby, this is Jaspreet. Can you hold on one second?
Sure.
Yeah, I was going to ask a question of Brian and Nate. They were going to discuss or show their LOIs and spreadsheets that they leverage. Is there any chance that they could share that with us in an email or with you guys? And
Probably just if you can join their program, that might be the best way to do it.
okay, thanks.
Yeah. All right. So what I'm going to do is I'm going to add a new asset. And you can track your syndications, your notes, your trust deeds, your fix and flips, your for sale, anything of that nature. But in this case, we'll keep it simple. We'll go with a rental, and I am the owner of that rental, and this is my email address. And in this case, it's actually not self-managed. It's managed by one of my property managers. And I'm just going to say other for now. But we do talk to several other property management systems. We're not a property management platform, but we talk to a bunch of property management platforms. So I'm just going to click on save. Okay, I think they're working on the side, but let me see. Okay, it's not saving. Let me try again. Let's just say save here. Okay, no, all right, it's not saving for some reason. So what I'm gonna do is I'm gonna log out and show you my other. So this is what it would look like if you had everything in there. This is why we need some beta users. So I think he's okay. I think I know why he's pushing some code right now. So anyway, I'm gonna hold off on the demo. I'll do it another day. But the site is called bettercapital.us. I do have a video over here. Let me see if I can share this with you. Greetings, folks. Bobby Sharma here with Better Capital. So if you're interested, I'll send you this this link in chat, and so yeah, there's a video, but if you will take a minute, just watch the video. And then just give me your feedback on what you think. But the next time we meet, I'll do a full-blown demo. I know we're doing development, and actually my partner is working on the code right now and uploading the code. So that's why I told him around 1:30 we would be done. We would be doing the demo, but anyway, I think if you have any questions, please feel free to ask. All right. What we'll do is, with that, I'll let you guys, enjoy the rest of your afternoon. But please reach out to me if you got any questions. I've sent the YouTube video, and then the website is bettercapital.us, but we'll do this again in a couple of weeks. But thank you again for joining and spending your Saturday afternoon. Thank you, Jeff. We'll see you guys soon. All right, take care. Bye-bye.